Hello, good afternoon. You've tuned into MF Corner on CNBC-TV18. I'm Vinnii Motiwala, with me Sonal, Bhutra as well. Sonal, very good afternoon to you as well. Thursday again, and when we help our viewers with everything related to MF Corner and mutual funds.
That's right. So, Vinnii, today I thought we often talk about loans against property, loans against the assets that you have. There's a concept called loans against mutual funds as well. So, should one do it? Should they go about it? And is it really something that helps an investor or not? We are going to discuss all this and a lot more with our guest today, Mohit Gang, the co-founder and CEO at Moneyfront, and Harshvardhan of Roongta Securities. Gentlemen, good afternoon. Thank you so much for joining in. Let me start with you, Mohit, and break it down simply for our viewers. What is this concept of loans against mutual fund investments? Do investors need to redeem the investments completely in this case?
Yeah. Hi, Sonal. Good to be back with you on the show. And look, loan against mutual funds, it's also called as loans against stocks, loan against shares, or advances against financial assets, right? So this is basically a secured overdraft line which is drawn on the existing mutual fund portfolio of an investor. So if you have an existing portfolio, you need to lien mark or hypothecate that portfolio. The lender will freeze the portfolio for you and give you an overdraft line against the holdings which you have. Now, this overdraft line typically enjoys an interest rate which is much lesser than the personal loan, which is more unsecured in nature. Because this is secured, it enjoys an interest rate which is much lesser. It's a sleeper line. You can withdraw as much as you want at any point in time. Interest will be charged only on the amount which you withdraw for as many days as you withdraw, right? So, and the good part is it keeps getting revalued every day basis the portfolio value of your mutual funds. There is a different hypothecation for debt funds and different value for equity mutual funds, which is provided against this. So it's a very user friendly kind of a thing which an investor can always put into place against his long term assets which he doesn't wish to redeem, so that he always has a placeholder or always has a liquidity drain which is available to him or her whenever they want to utilize the funds.
Right, Mohit, as well as Harshvardhan, good afternoon. Harsh, I'm going to actually come to you. Are there some rules or policies only post which an investor can actually go ahead and take a loans against their mutual fund in terms of investment? What are those policies that we should watch out for?
So, well, Vinnii, very simply put, this is an overdraft facility. It's like a limit that you've been granted. And so let me take it process-wise, step-wise. So the first step is that as an investor, you have certain investments in your mutual fund. So we're talking about loan against mutual funds specifically. So we'll focus on that. So you have certain investments in the form of mutual funds. Say it's equity fund, for example, though you can get the limit against even hybrid funds, even debt funds. So for example's sakes, we take the case of an equity fund. You have certain investments which you will need to pledge it to the lender. So whoever is the lender in this case, you will have to pledge your units to that lender, against which there will be a margin. So suppose you've hypothecated about 1 crore worth of mutual fund units as per current market valuation. And if it's an equity fund, and we assume a 50% margin, so you will be given a credit limit of 50 lakh of rupees. Now that limit you can actually withdraw and get the money in your bank account to utilize it for whatever purpose you wish. So the lender is not going to ask you what is the end use of this money. So you can use this money the way you like it. Supposedly you use this money for say 15 days. So you will pay interest only for those 15 days of using that money. So you had a limit of 50 lakhs. Say you withdrew only 10 lakh of rupees and you used it for 15 days. You pay interest only for 15 days. The rate of interest in the current scenario is about 10.5%. So you pay interest only for 15 days and you can repay this money and close the overdraft limit. This 50 lakhs will still be available to you to be withdrawn again in future. Now, what safeguards you have to take care in this case is, in n number of cases, we've seen investors who are going a little overboard. Now, I'll tell you how. Now, you have a limit of 50 lakhs against an investment of 1 crore. Now, what they do is, in some cases that I've heard, is that investors use this 50 lakhs to speculate into stock market, to buy shares probably, or to reinvest it back into mutual funds. In the estimation, in the hope that they will make extra returns. With 1 crore, they're actually they're investing 1.5 crores in the market, so they'll make more money. So I think the rules that investors should follow in this particular case, it's a lovely product. It's like a credit line given to you. So you pay interest only on the amount that you've actually withdrawn, not the limit that you have. So use this very prudently for any temporary use of money. So say suppose you had some requirement 15, 20 days down the line or 2 months down the line. So you don't need to redeem your mutual funds. You don't have to pay capital gains. You don't have to pay exit loads, nothing. You just pledge them, get a limit, use it for the time period that you need. When you get your cash flows, repay it back. So I think it's a lovely product if used prudently.
Got it. If used prudently, that's the big caveat, right? Mohit, if you have anything to add to this question itself, if there are any limits to certain kind of mutual funds, be it debt, be it equity, if there are certain mutual funds which can't be considered for counting or, calculating that pledge that you're creating, and some benefits that you would want to talk about when it comes to loan against mutual funds.
I think Harsh has very beautifully put it out all. But against debt funds, typically the lending line can vary. If it is liquid funds or ultra short-term funds, then it can go as high as around 80 odd percent. For long-term debt funds or for some different varieties of debt funds, it can be around 75% also. That can vary from lender to lender. Against equities, typically Sonal, the rate is 50% and that doesn't vary much. I think most of the lenders will follow a 50% LTV against equities. There are certain categories which are not eligible, especially locked-in funds or closed-ended funds. So if you have any closed-ended funds in your portfolio, if you have an ELSS scheme, which is a tax saver scheme, then there is no line available because those can't be redeemed at the back-end call of the lender or the investor both. Right, and there could be certain categories or certain funds which are not approved. These could be, let's say, low AUM funds or very high risk funds or very volatile funds, and there could be certain stocks which are not eligible, which could be micro caps or small caps, and there could be certain bonds which are not eligible. So there is always an approved list with every lender which is available against which the funds are disbursed. The second part to your question, Sonal, look, this is a sleeper line. It can be utilized at any point in time, especially for emergency scenarios. Let's say if you, God forbid, if you have an hospitalization where you don't have a cashless policy, you have to immediately make some upfront payments, then you can immediately withdraw funds. And as and when you get your insurance claims back, you can replenish the lines. They should not be utilized for speculative activities, which Harsh said. Typically that utilization though is not monitored, but it is kind of prohibited that you don't use it for further speculative activities. Should be used only for emergencies and exigencies in life. Let's say you need temporary bridge funding for 3 months, 6 months, for which you would not want to redeem your portfolio. And for those, the cases could be numerous. Let's say you don't want to incur an exit load, or let's say you don't want to pay capital gain taxes, or the markets are not very conducive for you to redeem right now. You just want a bridge funding for 3, 6 months or even a year. Then I think this comes in extremely handy that you pull out whatever amount is needed and replenish it back as and when you have the liquidity available for you. It works like a debit card. You also have a debit card. You can go withdraw any amount you want and you can put it back whatever amount you have handy. So I think it's a great facility for everyone to place on their strategic long-term portfolios only. Just mind it that you can't redeem once you have lien marked the funds, so you can't redeem them before opening the lien.
That's really interesting there. But Harsh, how do mutual funds actually decide on the interest rates for this as well? Is it actually pegged against the repo rate, or what is it that we're watching out for there?
Vinnii, interestingly, this is a secured loan, right? So the interest rate, as Mohit mentioned in the opening line, was that being a secured loan, the interest rates are lower than an unsecured personal loan kind of a product. So in this case, the interest rate currently are about 10.5%. That is on an overdraft facility. So it's not a term loan kind of a thing where you've taken the day you apply for the loan and you get the money or you get the line, you will start paying interest. So effective interest rate, if you see, supposedly you had this limit of 50 lakhs, you've used on and off. So effectively, you will see over a period of the entire year, 10.5% is annually. But if you've used it only for 3 to 4 months, you're paying interest only for that much time. So while I don't think it is linked to any repo rate or saying that it's an MCLR kind of a loan where it is linked to the repo rate and then it gets adjusted automatically, it's more to do with the cost of lending that possibly the lenders would want to evaluate. 10.5% is the rate as of today. And of course, if the interest rates go up and, the lenders would definitely increase. It has been revised upward once at least. So I guess you will not be able to link it to an external benchmark rate where you'll get an estimate of saying whether my interest rates are going to go down if RBI was to cut rates.
Got it. So this is how it works, and I'm assuming all the players have different rates, or is it largely similar across the board?
Is that question to me, Sonal?
Yes, Harsh.
Okay, so by and large, competition is very high in this segment because it's a loan against securities. You have a security against which you're giving loans. Interest rates are more or less in the same lines. You would not have somebody suddenly charging you 11% where the loans are so easily and freely available at 10.5%. The process of getting this loan is also very simple. You don't really have to run around to branches of any lenders. It's just an online process, and probably 15 to 20 minutes, you would have the money credited in your bank account if you wish. So, the execution is seamless. The product is very transparent. It's a secured product. It's very unlikely that the difference in the interest rate offered by a lender A and lender B would be in excess of 50 basis points. So, of course, as an investor, you would need to be cautious. You need to hunt if you can get anything cheaper. But 10.5% is on an average the rate as of now.
Okay, 10.5% is the average rate as of now. Mohit, you did mention that, obviously you shouldn't be using these funds when you take this loan against mutual fund. Don't be using it against speculative activities. But what are the other key risks against borrowing against these mutual funds? Are there anything that we should be keeping an eye out on as investors?
When you look like any other loan, this is finally a borrowing which has to be paid back, right? And you have pledged your assets. In this case, the assets are mutual fund units which you have pledged against the borrowing which you have taken. If at any point in time you are not able to repay back, or if you're not able to service the interest portion, then the lender reserves the right to sell your units and recover back the amount. That's point number one. Point number two, let's say if there is a 50 lakh line which you have taken and your borrowing is completely full, you have withdrawn 50 lakhs out of it, and suddenly the portfolio value of your mutual funds corrects. There is a big market correction, the portfolio value corrects, then this could trigger a margin call. So you would have to immediately replenish back the margin amount by which your portfolio has fallen, so that the line remains to a 50% LTV value. And if you don't have liquidity then, or if you don't have surplus funds to pledge then this could also trigger again a selling by the lender. So there are multiple risks. I think one very big caveat out here is never overdraw this line. Let's say if you have a 50 lakh line, just keep aside those 5 lakhs aside for the margin utilization, let's say because of any fluctuation or volatility in the market. Never try and utilize 100% of the line unless you have more units to be pledged or unless you sit on huge pots of liquidity. So that could be a very big potential risk out there.
Okay, take that point. Gentlemen, very interesting conversation, but I think we've covered a fair bit of it. We have to get into a quick break. On the other side, we'll talk about GST on the entire mutual fund trail and how does it impact investors per se. Stay tuned for that. Welcome back. You're still tuned into MF Corner. We still have with us Mohit Gang of Moneyfront and Harshvardhan Roongta of Roongta Securities. Now we are going to be focusing on GST on mutual funds. There are so many activities that take place in a mutual fund transaction, right? How does it impact an investor, and what are the different charges on an AMC per se? Let's just understand that. So Harshvardhan, let me take that question to you. What is the GST rate on the entire process, investing in mutual funds, redeeming investments, expense ratio, etc.?
So, well, Sonal, as far as an investor is concerned, as far as an investor is concerned, the investor pays a TER, the total expense ratio, and that total expense ratio includes all the costs that internally a mutual fund incurs towards operations of mutual funds. So, say for example, there is a scheme which has a TER, a declared TER of 1.5%. That 1.5% includes all the costs that the mutual fund would be incurring internally for, say, when they buy and sell shares, there's a brokerage they're supposed to pay. There are operational costs, there are regulatory fees, there are registrar fees, the custodian fees. All that fees that is put is clubbed together into 1.5%, which is a declared TER for a particular scheme. Now, this 1.5% also includes the GST. So as an investor, the only number that you are concerned about is what is the scheme TER that you're paying, the total expense ratio. So, well, and the rate, as you mentioned, in most of the services would be 18%. However, coming back to the point, as an investor, to avoid complications, the TER, the total expense ratio, is the number that they should be looking at.
Okay, TER is the number that they should be looking at, and most of them are charged at 18% itself. Mohit, what I also want to know is about advisory services, right? So how are these also charged under GST? Are these services more expensive? Is that some different rate there?
Happened post GST is that all services or all operations and everything pertaining to mutual fund activities or operations have come under a single rate of 18%. So whether it is something which is a distributor commission, whether it is a management fee, whether it is a broking charge or any other activity charge, it's all charged at 18%. And as Harsh said, it is inclusive in the TER of the fund. When it comes to the distributor commission or the advisory fee, which an advisor or a fee only advisor or an RIA is charging, even there the GST rate is 18%. So if an RIA or a fee only advisor is charging, let's say 1% or a 0.5% fee, then he or she will over and above that be required to charge an 18% GST also. Similarly, if a distributor is receiving commission from a fund house for his activities, that commission will include 18% GST. So that will have to be paid. Most likely, the fund house will deduct it from the commission itself and pay it on the behalf of distributor if he's registered with the with GST. For distributors who don't have a turnover over 20 lakhs, then this GST rate doesn't apply there, as in the fund house doesn't deduct it.
Got it. So majorly for any investor, it's going to be the total expense ratio, and GST is applicable on that, and it's covered under that TR already. So that's important for an investor per se. Mohit, coming back to you itself, are there still some tax loopholes in the mutual fund space which need to be addressed, be it the category or different schemes, not only from GST, but even direct tax perspective as well?
Look, Sonal, from a GST perspective, I think it's pretty uniform and fair now. I think it's all fair and square. From a DTAA perspective, which is the double tax avoidance agreement which India has with multiple countries, and from an NR tax perspective, I think there are pretty much there are a few loopholes which could be looked into, right? So which is, and one of the bigger things which have come into notice is that, let's say if you are let's just for take an example, let's say if you are residing in Singapore or in UAE or in Middle East, right? So India has a DTA agreement with them, and if you sell units of mutual funds in India, then obviously you're not getting taxed out here. You are supposed to, because of the DTAA, you are supposed to be taxed in the country of your residence. But these countries are all tax exempt. So technically you end up paying no tax. Now, what we have noticed in our observation is that there are multiple such cases where ultra HNIs who have large books of mutual funds, when they want to sell huge chunks, they typically change their domicile. They would stay in these countries or so show domicile in these countries for over 183 days to claim domicile there, and then sell the mutual fund portfolio to avoid any taxation. Now, that's a big loophole, and I'm pretty sure it will get addressed in some manner or other, so that taxation is at par with the resident Indians on these cases.
Okay, so that was the new case. Harshvardhan, I know we had spoken about it earlier as well, but there have been, is there anything on your mind, do you think, apart from what Mohit says, should be addressed, or it's largely okay and there's nothing really that comes to your mind at present?
So, well, Sonal, Finance Minister has been very proactive in addressing the issues of the mutual fund industry. So recently, I mean, before the change that came in with the tax slabs, long-term and short-term being categorized as 12 months and 24 months, like all investments being bucketed under these two tenures, there was some kind of a difference between taxation on gold mutual funds with what a physical gold would be taxed at. So, that came in because of the taxation rules that changed for the debt mutual funds. And anything non-equity fell into that bracket. The point I'm trying to make is the Finance Ministry and the mutual fund industry and the regulators have been very proactive in addressing all those cases where there is any, differences or anything that needs to be addressed. Right. Now, with regards to the DTAA, I concur with Mohit on that part. But I guess there are certain areas which are more to do with international taxation than to do with direct tax.
That's right. That's right. Makes sense, Harshvardhan. Thank you so much, gentlemen, for joining us today. We spoke about a whole host of things, and it really did make sense and help our viewers as well understand these new concepts. So thank you so much for tuning in with your expertise. With that, we'll take your leave on this edition of MF Con today, but stay tuned for Closing Bell to take you through the last hour of trade.